Welcome to Growing Empires. I'm your host, Jennifer DeJesus, and today we are going inside the deal. So this particular episode is one where I'm going to break down a very specific deal. And we're going to start from how we sourced the deal, to how we underwrote the deal, to what we did in due diligence. And then we're going to talk about the capital and debt stack, long-term value add play, and whether or not there's a refinance or some kind of exit strategy that is upcoming. What I'm hoping to get out of the Inside the Deal episodes for you is to give you an opportunity to look at your next deal through a more creative lens, to give you an opportunity to look at different options on every specific deal. While not every deal is an absolute home run, there are some that definitely hit the mark. This particular one did just that. And although we will talk about deals that are struggling and things that we're doing to change the outcome of a particular deal, I think it's also really critical to talk about deals that were absolute slam dunk home runs. And that's because they still exist, and they exist in any market. And yes, you heard me right. Literally any market, they exist. Sometimes you've got to dig really deep into that haystack. Sometimes you've got to turn over many, many rocks before you find the right deal. And sometimes you've got to look where nobody else is looking. And you can find just that, the right type of deal. Please don't misunderstand that part of having the right deal means you also have the right partnerships. The best deal without the right partners and the right executors on the deal could turn a good deal into a very bad deal. It's a lot more than just finding the right deal. It's also the execution of the planned post-deal that we're going to talk about. But today I'm really excited to get into this particular deal. It was quite the home run and is still yielding fantastic returns for this investor. And while it is a deal that happened a few years ago, I'm going to give you an opportunity to understand what the worst timing could do to a specific deal. So I'm ready to get into it. Let's get started. Welcome to Growing Empires. I'm Jennifer DeJesus, real estate investor and operator. This show takes you behind the scenes of how real estate assets are executed, managed, and positioned for long-term performance. Let's get into it. So what did we buy? We bought an 8-unit in Bangor, Pennsylvania. So why this particular deal? This investor had owned a few other properties, multifamily properties, prior to the purchase of this particular asset. And like I do with every investor, I always look at their portfolio because we want to make sure that we adjust the risks appropriately for the next acquisition. And I always have some sort of consultation with the investor, even if they're on their 100th deal, to talk about what are they looking for in this particular deal, what level of risk are they willing to tolerate, and what is their ultimate goal or outcome of this specific deal. For this investor, this deal was something that he was willing to take a little bit more risk. As I had mentioned, he had already owned a handful of other properties that were doing well. They were value add plays. All we had to really do was stabilize the assets, increase the revenue, decrease the expenses, and they were cash flowing consistently month over month. He was willing to take a little bit more risk. And for this particular deal, high risk, high return is what he was going for. So he's willing to do a little bit more renovations. He had capital that he was ready to deploy. He didn't necessarily need to worry about structuring debt at this particular time. So we were able to locate an asset that was going to, on the outcome, yield a very pretty return. So what did we find? Well, I had shopped and shopped and shopped for a specific deal. And we were not finding anything on the market at this particular time. And we are going back a few years. So it's not a whole lot different than the way that the market looks today. But we were looking pretty much anywhere for a deal. And we were looking for something that was a little bit more of a construction project. In this particular deal, what he was looking to do was renovations up front. So unlike the value add opportunity where you are going to increase the value over time through renovations, through increasing revenue, decreasing expenses, capital improvements, this particular deal, he wanted to essentially rip the Band-Aid off. He wanted to do all the renovations up front and be able to yield the cash flow on the backside. Because as I had mentioned, he had some capital saved up and he was looking to deploy it into his real estate holdings or his real estate investments. So while I was looking for a project that was a good value add opportunity, we were looking for that home run. We were looking for that riskier type of project, but also the project that was going to yield a much higher return on the backside if we found the right deal. And after searching the market for quite some time and not finding anything really that made sense, it dawned on me that what I should be looking for is what everybody else passed on. And we don't just shop on market, we shop off market. We have conversations with brokers, conversations with other investors. We go direct to seller. We buy short sales. We buy foreclosures. We buy estate sales. So there's no shortage of opportunities for locating properties. But I wasn't finding the right project at this time. That right project looked like something that we could just go into, easily put renovations in, and have a really high return on. We wanted to make sure that the asset was priced accordingly for the construction or the renovations that we were going to do. But we really wanted something specific, and it was something that nobody else was looking for. Where do you find something that nobody else is looking for? Well, where nobody else is looking. It dawned on me that I should be looking at expired listings. Why expired listings? Well, because nobody wanted the property. And why would nobody want it? Usually because the renovations were high or it wasn't priced appropriately. There could be a lot of reasons, but generally speaking, those are the two kind of things that will happen when the deal is something that nobody wants. Not everybody has a tolerance for major renovations. This particular deal that I found, though, was unique every which way. What I located was a 8-unit property that had been on and off the market for 2.5 years. And they were never successful at selling the property. I looked at some of the history and I saw that the prices were continuing to drop. I reached out to the agent who had the property the last time it expired. And I just said, listen, we're looking for a project. This looks like this might be a good opportunity for us. What is the deal with this project? And he said, well, the seller's pretty much MIA. I have no cash flow. I have no rent roll. I have no leases. I've got tenants in the building. I don't even know if they're supposed to be there. And you're not going to get any concessions. And I just kind of chuckled because this to me really sounded like a good opportunity. And only the strange people like myself would immediately think that this is a good idea. Most people run the other way. If I told an investor, I'm sorry, you have no rent roll, you have no income and expenses, you've got no historicals, and you've got no leases, most people are going to not walk, but run the other way. And what do? I run right to the deal. So what we ended up doing was I went to go take a look at the property. Boy, was that scary. Clearly, the people that I ran into were definitely not tenants of the property. They certainly weren't paying rent. I can tell you that much. With no leases, an MIA landlord, and somebody who was clearly not maintaining the building, there was no shortage of questionable people in the property. It was pretty apparent that there was drug use in the property and there were squatters in the property. And some of the property had no utilities running. I went back to the agent after I looked at the deal and I just said, listen, at the right price, we're willing to take this off your hands. And I think at the time, this 8-unit project was listed, I don't know, around 300, maybe 350, something like this. Again, it's going back several years. It just kept expiring. They kept reducing the price. It kept expiring. And then again, I think this agent just got frustrated because the owner was just non-responsive and questionable stuff going on at the building to begin with. I think he was just done. And I went back to him and I said, listen, is there debt on the property currently? He goes, no, the person owns it free and clear. I said, okay, perfect. Are you willing to get rid of the tenants that are in the building? And the agent said, absolutely not. And I said, okay, Are you willing to have a conversation with the seller at a number that makes sense for us? That's not going to be anywhere near your asking price. He goes, listen, if I could sell this building, I'm ready to be done with it. He's ready to be done with it. Let's just get it off our plates. The town is giving us a hard time all the time. There's fines accumulating because of violations with the city code. And there's constant police activity at the building. So at this point, yes, he's really ready to get rid of it. We ended up buying this 8-unit project for $190,000 cash. Yes, you heard me right, $190,000. Now, granted, this was an absolute disaster from top to bottom. Not only were there squatters in the property, drug activity, there was police activity on a regular basis, and a very lengthy list of code violations, and a town that was just very frustrated with the owner. Not to mention, can you imagine how the neighbors felt or the local businesses that saw this particular property as a nuisance? So I went back to this particular investor and explained everything that I found, including the drug activity, the police activity, everything. And his question to me was, well, can you handle it? And I paused for a moment and I said, absolutely. For the right deal, I'll handle anything. Do we have viable methods and ways to deal with certain things? Yes, we absolutely do. So again, we bought the property for $190,000 cash. We closed in a few weeks. We didn't do really due diligence because what would it matter? It was $190,000. Do the math. You've never in your lifetime bought a property that cheap. So we were willing to take on whatever risk there was. Now, what our due diligence was, though, instead of doing a home inspection on the building, we did budgets for construction. Because before we bought the building, we wanted to make sure that once we renovated it and did what we needed to do, that it was going to yield a positive return. We did our due diligence by talking to the police about the activity that was happening there. We talked to local businesses. We talked to the neighbors. We talked to the code enforcement department. And everybody was raving at the opportunity to turn this building around so that it was no longer going to be a nuisance for the community. And everybody was on our side for whatever was needed to have cooperation to get it done. We had to get dumpsters out front. We were taking up some parking for the neighbors. We had to use land that was not ours for trash removal and stuff like that. Again, everybody was really willing to help us because we were helping the neighborhood. As a part of that due diligence, though, what we specifically did was looked at our construction budgets and made sure that we were not getting into something that we were not aware of. We completed a right to know request with the municipality. And that right to know request is something that if you do not do for every single property that you purchase, you probably are making a mistake. A right to know request is going to give you insight into any zoning potential issues, health violations, permitting issues, code violations, those sorts of things. Now, again, if you're buying a property that you don't really have any of those concerns, then maybe not, there's no need to do a right to know request. But in this particular case, we knew that the previous owner was completely missing in action. He was not maintaining the building. There were significant health violations, significant nuisance violations. There was police activity. There was code violations. So what we really wanted to do was get an understanding of the baseline. What are we starting with? What is the mess that we're starting with? Our due diligence was nothing more than construction budgets, right to know requests, and talking to everybody in the area. Because what we wanted to make sure is that as we move forward with the project, we were not going to have barriers in our way, like bad reputation with the code enforcement because they didn't like the previous owner, different things like that. We ended up identifying our construction budget to be a full gut rehab. It really made no sense to keep anything that was in that property. Plus, you never know what people are storing behind the walls, right? So we really wanted to gut the property and run all new plumbing, all new electrical, brand new kitchens, brand new bathrooms, everything. This was an 8-unit, full gut, down to the studs and rebuilt. The project was $250,000 to complete. There was limited exterior work that was needed on this particular project. We did some siding, we did some roof work, and we did some decking work, but nothing major. It was more like siding repairs, and there was a roof replacement, but the overall budget went to the interior renovations. And Empire Property Construction, my company, actually ended up doing this project because as we were bidding it out to multiple vendors in the area, we were just able to find ways to value engineer it and to keep the costs down for our investors so that he could yield a much higher return. So although Empire Construction doesn't necessarily take on every single project for an investor, we did take on this particular project. Because we have licensed plumbers and licensed electricians on staff, it also made the permitting process very, very smooth for us. Although there is always a waiting game when it turns out that you need permits and you need inspections, it does speed up the process when you have those licensed plumbers and electricians on staff versus somebody that you have to sub out to. We ended up identifying a $250,000 construction budget, $190,000 acquisition, and then we had about $50,000 worth of holding costs between utilities, insurance, dumpsters, trash removal, certain things like that over the course of the renovations. The renovations took a full year to complete. So that's what I mean by holding costs. It's the cost of holding that property through the things that you would have to pay during the renovations of a property, like the utilities, the insurance, and things like that. This particular investor bought this property and did the renovations all cash. And I realize that not everybody has that level of capital just laying around to invest. But for this particular investor at that moment, that was the right move for him. We could have gotten this property completed with a construction loan, a bridge loan, bridge debt. We could have done hard money, but construction loans are typically the type of structure that you would put in for a property like this. And they typically will do what they call like a bridge, which is from the time of purchase through the renovations, and then they will transfer it to permanent debt on the backside once the property is stabilized and renovated. So that was also an option. But again, for this particular investor, it was an all cash investment. Let's do some quick math, and I got to bring out my handy dandy calculator to do this. But $190,000, $250,000 in renovations, and $50,000 in holding costs. That gives us a total of $490,000. And I want you to keep that in mind because when I talk about the outcome of that property, I want you to really hear what those numbers are. We bought the property, went to closing, and we started our project. What was the first thing that we did? Well, the first thing that we did was give everybody notice that they needed to move out of the property. Some of it required court action. Some of it was people just leaving because they knew we were going to start renovating the building. But ultimately, it took us about 45 days or so to get the property fully empty. And we were not under any circumstances going to start renovations in a property with drug activity, squatters in a property. We weren't putting materials in there. We weren't doing any of those things. So 45 days or so until we got the property fully vacant. I would say it was about the 60-day mark until we were ready to start the renovations. We then first got our permits for the construction. What we identified during the construction, again, full gut rehab, but we intended to run new electric, run new plumbing. Most of the copper had already been cut out of the building and sold because that's what happens in vacant or distressed properties, especially over wintertime. People take the copper and they sell it. There was no working heating systems in the building. There were no working water heaters in the building. All the copper piping had been cut out already. So it just made sense for us to just redo all of the plumbing. And we ran PEX through the entire building. Since we were rerunning the plumbing to every single unit, it made sense that we separated all the water lines. So each unit had its now own individual submeter for its own water usage. What did that allow us to do? Well, it allowed us to transfer the responsibility of the utility onto the tenant. And it was separately metered. It was not done through RUBS billing. It was done through a separate meter. Ran new plumbing through PEX or ran new electric. That was the first part of our renovations. Then we, obviously, after we did all of our rough inspections, we were able to put drywall up, do all of our fire rating, our fire inspections, and then we started putting our kitchens and our bathrooms and everything back. It was about 12 months from start to finish of the project. Right as we were done with the renovations, it was time to lease the project. And I'm going to date myself here because the moment that we were ready to start leasing out the property was March of 2020. Now, if you can remember what happened in March of 2020, and I said that I couldn't have picked the worst time to finish a project, this was it. I believe it was like March 17th to be exact. That was the start of COVID. We went to work one day, everything was normal. The world is shut down the very next day. And for a moment, I paused and I was just like, oh my God, this really awesome project that we bought at this really incredible deal that we negotiated. We had a year-long construction project that stayed on budget, stayed on task. It was turning into be this win-win-win. It was going so well. And then COVID hit and the world was in shutdown. You're probably thinking, well, what does that have to do with anything? Well, think about what you couldn't do. A property management company was not able to show properties. So if I can't show a property, how do I fill up a property when I'm trying to lease it if I can't go to the property? It was like an oh my God moment because I just watched this investor spend, what did we say that number was? $490,000 essentially. $490,000 of capital has been deployed. We are at the onset of COVID, and what are we going to do now? I took a moment to kind of think. I went to my team and I said, listen, guys, we have an investor that spent nearly $500,000 of his cash. He's got an 8-unit building that just finished a year of renovations, and we have got to lease it up, and we can't show the property. So what are we going to do? How can we accomplish this? And how can we make sure that this investor's capital is protected and we don't let him down? And my team, my amazing team, I give my team the world's most credit because the ideas that they have come up with over the years when we would be presented with struggles, it's just incredible. It's incredible the way that they think. It's incredible the way that we kind of work together and come up with solutions. But the team came up with a very great idea. Well, we can't go there with people, but we can go ourselves, make video walkthroughs, video tours of the properties, and take pictures of everything. And we can post those video tours online and give people the opportunity to do video walkthroughs of the property before they sign up. When you think about it, although the whole world stopped, that didn't mean that people stopped moving. It meant that they couldn't go see properties. But the world had to go on, right? If your lease was ending and you were a tenant and you didn't have an opportunity to extend, you had to find a new home. You were presented with the same struggles that we were presented with, just from a different angle. My team's idea to get video tours and video walkthroughs and make it super simple for people to see these properties was absolutely spot on, the right thing to do. I'm very proud to say that we leased that property in under 30 days, all 8 units in the onset of COVID, when nobody knew what was happening in the world. And I'm very proud that that property today is still a very high cash flowing, what we call it a cash cow. It's the project that we wish we could duplicate over and over again. That investor started making his cash back right away as we had a fully occupied property. We also had tenants paying all of their own utilities. His costs went from the entire renovations to paying for nothing more than taxes and insurance and a common area like electric. Other than that, all the water was paid for by the tenants. The electric was paid for by the tenants. We got rid of the gas in the building because we didn't need it. So all he paid for is insurance, taxes, common area electric. So the building immediately started to cash flow. It's been a great cash flowing building for all of these years. About 2 years later, the owner decided that he wanted to refinance, pull his cash out, and go buy some other assets. 2 years later, probably about a year and a half later, he was able to pull his cash out. And remember I said he spent $490,000 on the property and then started cash flowing. Well, he was able to pull out $850,000, nearly double his investment in cash, and that still left a 35% equity position on his property. Because if you remember again a couple of years ago, and even still today, you're not refinancing for 100% of the equity. you're only able to pull out a percentage of that equity. He chose to pull out 65% of that equity, which nearly doubled his investment as return, cash back in his pocket, which he's then invested in other ways. And again, his money just continues to compound. Keep in mind that he bought this property for $490. If he got $850 in cash out and he left 35% equity in the building, that means that the value of this property went from $490 to about 1.1-ish, 1.1 million. Again, just do the math on that. That's the type of returns that you can achieve when you're willing to take a little bit more risk. It is critical, as I pointed out, to have the right team. And we may not always be the right team for the type of asset you may be looking for. However, having the right team and having that right team in place that knows what they're doing, has a foundation, has the structure, and can think on their feet when things go sideways is going to be the critical point where your investment either makes money or starts to lose money. Taking risk makes sense if you can make calculated risk where you and your investor can actually achieve the end result through strategy, through execution, and through foresight into the future of your investment. So I hope you enjoyed this story, and I would love to have the opportunity to help you find that next home run. But until then, I hope you are able to take a piece of this Inside the Deal episode and use it to your advantage on your next real estate investment purchase. That's it for now. If passive income from real estate investments plays a role in your long-term investment strategy, this show is for you. Thanks for listening. And for more in-depth resources, please head over to growingempires.com.